I just think this is the most interesting development in markets this year, or certainly one of them. There's been obviously tons of interesting developments, but the huge underperformance of banks in the stock market year to date, we're only 6 weeks in, banks leading the market lower, is a real red flag that I think people should watch and focus on very closely. What is driving that? Why are Japanese banks down 30% by mid-February year to date? Same in Europe. And there's a lot of things possibly going on, but I suspect the heart of it is the flattening yield curve globally. And I suspect that, of course, you always sell banks in that environment. That's telling us about softening global growth, and that's a good reason not to buy banks. On top of that, I worry that going negative on interest rates, and more deeply negative, as we've seen in Europe and Japan this year, is actually undermining their ability to make money in the long term. So, we're almost slowly shifting the ability of some of the financial systems in the West to generate profit, and in the long term, we're chipping away at their core purpose. So, I think the main message here is it's probably global growth slowing, the yield curve flattening. But what worries me is the impact of negative interest rates on the financial system as a whole. Quantitative easing as a concept is being effective in what it hoped to achieve. It's the other bits that we haven't had. I don't think negative interest rates are a good idea. I think they're deeply troublesome for the financial system. But quantitative easing was meant to collapse risk premiums, get risk assets up, generate confidence, and then we would have hoped there would have been some follow through on investment and business behavior and businesses' appetite for risk. That bit hasn't come. That may reflect the lack of reform in the way the world works, or that may also reflect the fact that we, haven't cleaned up the debt in the global economy. Animal spirits haven't returned. So we have to ask, why is that? I think that reflects the debt super cycle that we're in and the over-indebted global economy that we're in. So I think QE did what it was meant to do, but we didn't get the rest of it to bolster it and see the follow through. And perhaps policymakers didn't fully understand the implications of over-indebtedness.